we move on to a next session, which is quite interesting, which will require us to probably broaden our aperture a bit because it brings two thematic topics together. And we're going to be talking about tokenization of private markets. And we're going to have a session focused on the experience of those tokenizing private markets to really drive adoption. So with that, I'm going to invite Ryan Freeman from Ripple on stage to moderate this panel. Thank you.
I am Ryan Freeman. I am a director of North America at Ripple. Pleased to be moderating this panel today with my esteemed colleagues. The last day and a half, we've talked a lot about tokenization, and we're going to continue that theme, but really narrowing the scope here on the privatization, or tokenization of private markets. There's a big shift in movement, as we're all been talking about, but the real challenge is making it work on the ground, right? So what's it going to take for adoption? There's implementation, and then also scaling, right? So we're going to do a deeper dive today and really get at what does it take to take this from concept to an actual reality. And so we'll kick it off. Happy to have a varied expertise panel here with Rory, Dennis, and Stephanie, and I'll let them each introduce themselves.
Thanks, Ryan. Hi, everyone. My name is Rory Callaghy, and I lead the funds and asset management ratings team here at Moody's. And I think my connection to this topic is we rate alternative asset managers that are issue debt that obviously are looking at tokenization as a way to provide broader access to their strategies. And then actually within my team, away from private markets, we've started to assess tokenized funds. So we've had to think about the risks associated with this novel concept. So hopefully be able to provide some insight.
Hi, good morning. My name is Dennis Donayev. I'm the product owner at the DTI Foundation. What we do is we issue unique identifiers under ISO standard for all digital assets. So crypto tokens or cryptocurrencies, tokenized financial instruments, all of these get a DTI. We're also, and that allows the interoperability between different blockchains. What we also issue is the ISINs, which are more kind of traditional finance identifiers, which allows the interoperability between the blockchain infrastructure with the traditional finance.
Stephanie Breslow, one of the co-heads of investment management at Schulte Roth. I've been doing this crypto work since 2012 for that first fund that Pantera launched in 2013, which I did with them, and a lot of them for them and others since. I'm a real believer, but at the same time, I'm going to have some depressing news about regulation when you get to me.
Lovely. All right, so at a high level, right, why tokenization? What is really driving this interest? So I'll start with you, Rory. The private markets are definitely growing fast right now, but what would you say is the fuel that's driving that growth? And why is tokenization a key focus right now for asset managers?
Sure, Ryan. Maybe to take a step back, if we look post GFC, where we saw rapid growth in the private markets, a lot of the growth was driven by the fact that interest rates were at zero, and it was hard for investors to find return yield, and therefore we saw a lot of money flow into private strategies, particularly private equity. Obviously, the world has changed a lot since then. Rates are higher. Economic growth is slowing. But I think what's continuing to fuel, in my opinion, the growth of private markets is that capital formation is shifting. Governments that provide capital are dealing with big deficits. They don't have the firepower to support investments. Companies are staying private longer. We're not seeing much activity in the IPO market, so that's providing more opportunities for alternative asset managers to provide capital to the market. And banks, regulations of banks globally are constraining their ability to provide capital to borrowers, and that's why we're seeing most recently huge growth in the private credit market. But I think one of the challenges that the industry has, from here in terms of raising more capital is that the private funds have historically been capitalized by institutional investors, pension funds, sovereign wealth funds, insurance companies, and many of those institutions are, sort of bumping up against their target asset allocation. So their ability to continue to, commit more capital to alternatives has reduced. So I think that's where, tokenization, comes into play. Is that alternative asset managers are looking to, the wealth market as a way to, continue to, accumulate assets under management. But one of the challenges there is that often, they're very high minimums are required to invest in private funds. And I think tokenization is potentially, its early innings, a solution there, because you can have fractionalization and you could potentially lower the minimums required, and therefore, I think, achieve the goal of providing, more access to, wealth investors that, historically haven't had, exposure to this part of the market.
Yeah, I completely agree. So on that note, Dennis, I'll come to you next. There's the growing interest right now, as we heard about from asset managers and investors alike. But from your expertise, how critical also is that underlying infrastructure, right? What needs to be in place from an infrastructure standpoint in order to scale?
So I think scale is the key word. We're all seeing a lot of pilots and sandboxes. I think for this to become sort of scalable solution ongoing, we need to make sure that we get the fundamentals right. I've been in traditional finance technology for 20 years. A lot of the time was on the support, running the support desk for the equity trading. The issues we had all the time, the biggest issues were around reference data. Things were not created correctly, things were not matching, trading didn't happen because we used the wrong identifier, settlement was broken, again because the reference data was incorrect on both sides. And I think with the kind of this industry, we're kind of moving in the same direction. And my worry is that the fragmentation with all the different blockchains, with all the different technologies, creates the same problem, where at the top level you can come up with fantastic deals and kind of unlock liquidity and democratize the access to assets, but then you kind of get to the bottom, to the settlement, to the getting off the chain. Reference data is very fragmented. All the companies kind of using different standards. They keep their own golden source. And I think where we come in with the ISO-backed identification of the tokens allows that foundation to be built from beginning, and that will allow that business to become much more scalable a lot quicker than what we saw in traditional finance.
As a follow-up to that, if you had a guess from a time frame standpoint, how long does it take for the mainstream to adopt scalable technology like that?
On the crypto side, or on the
Yeah.
I think it is moving that way. I think over time there will be a clear distinguishing features, I guess, between the different technology providers, and they will coalesce around the standards. It's already happening in some places around the, for example, standards around the smart contracts that are inter-blockchain. And we are moving with the identification as well. We saw a big move for that in Europe under MiCA, DTI, and ISIN were mandated under the regulation. And I think that's sort of a stick. But then there is sort of a carrot side, where if the industry kind of moves ahead of that, it can be ahead of the regulation. So I think maybe 10 years, but it really kind of depends on the technology coalescing around like clear winner or winners.
Yeah, no doubt. And you mentioned regulation there, which is a nice segue, because obviously the demand needs to be there, the infrastructure. But I'm going to pivot now to Stephanie. And as we think about regulation, we think about compliance, standardization, can you help us set the regulatory scene here? And in your opinion, what are the key hurdles today in tokenizing private assets, and how are these firms navigating those?
Okay, now the depressing part. So tokenizing an asset that is going to have some connection to the US, whether that's because the holder is going to be US or because the person who is running that business is themselves in the US, is not going to somehow remove the regulatory hurdles that would have existed if that same asset were traded in untokenized form. So, for example, if something is a privately placed security, it's not a registered product, it's not an interval fund or subchapter M mutual fund or whatever. If it's a private fund, for instance, and it's supposed to be privately placed, still true if it issues tokens. If those tokens can only be traded under Reg D or Rule 144, still true of the tokens. If that issuer is supposed to comply with AML and KYC, still true of the tokens. If that thing is a fund that falls under the 40 Act and is relying on 3C1 limiting its holders to 100 or 3C7 limiting its holders to qualified purchasers, still true when it's a token. So unfortunately, when we're talking about securities and we're talking about the US, this isn't the open sesame to the retail market. There's a separate question that I know our administration is working on of whether more private assets should be open to the retail market, and that's a fair question, and that will be different regulatory initiatives. But merely something that involves turning something into a tokenized asset does not suddenly mean that mom and pop are trading it, because again, they're subject to those same restrictions. And the issuer, by the way, if there's more than 2,000 of those things floating around out there and it is a security, well, that's the 34 Act saying, well, now I need to register as if I were doing a public offering. So that's the bad news. So it's easy to tokenize assets that are not themselves securities. That's great. You want to tokenize art or something, it's a very different conversation. And if you want to do this stuff outside of the US market, to be traded outside of the US market, okay, also good. If you have offshore vehicles that themselves are not primarily about US natural persons or US trusts, often those vehicles themselves are Reg S purchasers, which opens up markets. So there are things you can do to broaden access, but the token itself is not the magic thing that causes that to happen.
Very well said.
Now?
Well, I appreciate your take on the regulatory aspects of it. Adding to that, I have a follow-up for you, really two parts now. On one is on the compliance side, and the other is kind of as we look to standardize things. But what are the, I guess, compliance factors that investors and managers should keep in mind? Part one, and part two, how does tools like automation and smart contracts, how could those help?
There are a bunch of things I think could help. I mean, one obviously would be some regulatory relief, including, by the way, on securities exchanges, because right now, securities exchanges themselves are regulated, and they're not regulated in a way that really enables you to comply with a 24/7 market. So some sort of exemptive relief that would actually allow regulated securities exchanges to be 24/7 would be super helpful. And by the way, if that sort of thing had been in place, we probably wouldn't have had an FTX. So really, driving everything offshore is not everybody's help. But that would be great. I think individuals might ultimately use smart contracts to sort of pre-qualify themselves. I think we might get to a place where we have people who are, through their own tokens, able to say, I am a QP, I am AML compliant, I am clean, and we'd be able to get rid of some of the cumbersome processes of the subscription document process and verifying each manager, verifying somebody's AML status every time. I mean, you could imagine that that becomes part of our decentralized ledger, and that would be a lot cleaner. So that would all be great.
Wonderful. So, sticking with standardization, Dennis, I'm going to come back to you. We bumped into each other in Toronto last week at an event, and one of the things we were chatting about was how their data fragmentation is a big challenge with traditional finance today. Many things are siloed. There's not a lot of glue and connectivity. So the question I have for you is, how can better token standards and identifiers help to improve interoperability and overall just build confidence?
Sure. So I think the blockchain technology as a foundationally is decentralized. So there is, I guess, there is no limit on what you can call your token, which is good, I guess. But what it means is that anybody can create a token called BTC or ETH. There are over, I don't know, there's a couple of hundred different ledgers and new ones being created that utilize different ways of identifying tokens uniquely. So all of that kind of stuff, and we hear stories about people thinking that they bought a Bitcoin when they bought some smart contract that somebody called Bitcoin. So I think having the common way of identifying tokens, and it cannot be just something that's human readable or something like a BTC or Bitcoin. It has to be something that's machine readable. Having a standard across different blockchains that uniquely identifies tokens across multiple chains is foundational for these tokens to exist in this ecosystem. You also need to have identification of these tokens outside blockchain, because eventually everything that's on blockchain will have to come off. You have to, you spend your money out of the blockchain on food or property or whatever. So all of these things need to integrate seamlessly. If we all lived on one blockchain and everything was through that blockchain, then we wouldn't need this. But we are where we are. We are in the real world. These standards are needed to improve the market and to improve the usage of it by the general public.
Yeah, I mean, so what you're saying is we're still fragmented in this world, and we will be for a while. But you have hope that there will be progress where there'll be more of that interoperability, stickiness, connectivity than in the kind of fragmented traditional system we have today?
I think so, and I think that that those standards need to be outside the sort of native blockchain. They need to come in and kind of be the glue between different things. Fragmentation by itself I don't think is bad. There are different use cases for different blockchains. That's sort of I think one of the advantages of the blockchain. But I think to connect it to real world and to connect different blockchains together or different DLTs together, you need to have these standards. And I think we are actually ahead in this space than we were in traditional finance, say, 40 years ago. So, we already have this in place. I think it's just for industry to catch up and make sure that that's there at the foundational level rather than put something in it later which will create more problems.
No doubt. We've heard on earlier panels, right? The internet has been around really like 50, 60 years, but didn't really take fold until the late 90s. And now we're seeing just the iterations from that, and probably the same with this technology too. So all right, we've covered the demand coming in. We've covered a lot of the regulation, compliance. At the end of the day, all that is gravy, but it has to bring value, right? We've heard in other panels, if there's not value and drive that we're providing for consumers and businesses alike, what's it for? So in that vein, we'll circle back to you, Rory. From an asset manager's perspective, outside of efficiency, what is attractive about tokenization? And are you seeing any shift in how products are being structured at all and who they're being offered to?
Yes, I mean, listening to Stephanie about regulations, it sounds like there are high hurdles. But when we talk to alternative asset managers, they're excited about this innovation because I think it potentially delivers value to them and to their investors. So from an efficiency perspective, in the private fund space and the mutual fund space, there's a lot of manual processing, a lot of duplication, so a lot of friction that ultimately eats away at investor returns. So I think tokenization, blockchain, smart contracts, would provide some benefit there, and potentially providing more alpha to investors by reducing costs. I think secondly, specific with private markets, the assets are illiquid, right? So the ability to trade a private fund, you have to go to the secondary market. Obviously, there's a lot of complications with that. So tokenization, I think potentially could provide more access to liquidity, more tradability, which I think would be positive for the overall market. And then thirdly, I think one of the reasons why asset managers are so excited about tokenization, at least the ones that we talk to, and some are dipping their toes into it. Apollo, Hamilton Lane, KKR, I think have done variations of tokenization with private funds. Is that it potentially provides more access to a swath of investors that historically haven't had access. And with that, when you're going to the retail market, you need to provide more transparency than you would to sophisticated investors that know what they're probably getting into. So I think tokenization potentially provides that transparency. So I would based on the conversations that we're having with managers, those are sort of the three things that they highlight.
Great.
But I would like to note on that, these products are often registered products with some sort of feeder coming in that's offering a derivative on them. It's not the case that retail investors are readily able to trade some sort of actual private fund that is not registered in some way with the SEC. I haven't suddenly opened it up where a private fund that previously you needed to be a qualified purchaser to get into, now you don't. You're still there. So the dipping in right now is about products which themselves have a pretty high degree of oversight.
Yeah, maybe actually a question to Stephanie. I was in preparing for this. And we were actually talking about this Apollo Diversified Credit Fund, and I was reading that you actually can take the tokens and borrow against them. So talk about another utility is that you can use that as collateral to borrow against. I thought that was pretty interesting.
I think in general, the fact that stablecoins and tokens generally have the ability to offer quicker liquidity is going to make it more likely that these things can be borrowed against if they're otherwise freely transferable. Obviously, if they're not, your lender is going to look at it and go, well, I'm not actually allowed to take it. But let's assume that it's freely transferable, then sure, being able to get your money out in a day as opposed to waiting for some bank for 3 days is a huge advantage.
No doubt. Instant settlement 24/7 is huge value. Going to propose this question out to all of you. It's kind of an overarching theme of the conversation we've had today. But as this momentum continues to build in each of your respective expertise industries, what do you think it'll take to move these tokenized private markets to mainstream? There's a lot that needs to be done, but from your vantage points, what's the first thing that needs to be done? I'll start with you, Stephanie.
Me again. Okay, 24/7 registered securities exchanges would be really high on my list. If people could get to those exchanges and trade tokenized assets, and those exchanges would be approved by the U.S. I mean, people like Coinbase wrote a wonderful white paper about all the reasons why they couldn't actually register. And that needs to be fixed because there's no inherent reason why securities exchanges couldn't be regulated and handle these assets.
Dennis?
I think from technology perspective, I think we're already there. I think it's really sort of having clear regulation, having kind of products out there, having participants, but from technology and from the standards, we're there. We just need to start using what's there, and from the crypto side, the people coming in on the crypto players, they can look at the tools that the traditional finance already established, like fixed protocol, Swift. They might need some adjustment, and there's some on-chain, off-chain stuff, but there's a lot of things that are available and ready to be used for this use case.
Just to echo, comments, I think, based on conversations I've had and, listening to Stephanie and Dennis and Ryan talk, more regulatory, certainty, I think would provide, more confidence. And then talking to my colleagues in our digital economy team, more confidence in, digital cash. I think that there's some concerns around, the reliability of stablecoins. And I think that, if there's more sort of certainty there, I think that would be a positive.
Absolutely. You know, one of the things at Ripple, we talk to businesses of all sizes and industries, and I think a big element that we all recognize is education is paramount. There are some that are very well versed in this space and have experience in it, but predominantly, most don't have a deep knowledge of all of it, right? And you each bring different elements of expertise to that. So with that being said, if we're one big consulting group here, and there is a mid-size asset management firm out there that's looking to get started, they want to dip their toes here, they don't know where to begin, how would you advise them? What would be the first step that you would recommend that they take to prepare for a tokenized future? And we'll start with you again, Stephanie.
Me again. Okay. You know, in my experience, my clients who dip into this space often are dipping into this space by beginning to trade digital assets, which obviously they can do. So that's a starting point. A next thing people are thinking about is whether they can make things quicker and more frictionless by beginning to let people in and out with stablecoins, where again, faster nights, weekends, very tempting. As far as tokenizing your fund itself, I mean, you really do have to ask, okay, what advantage have I now offered to my investors by doing that? And again, if it's something that's not going to be freely tradable either way, we may need some regulatory improvements before we get to a place where that actually makes sense. If it is a registered product and it's pretty freely tradable as it is, or if you're doing this offshore, which is great, you know, it may be that those tokens are an easier way for people to trade. And you also have to think practically about how, if at all, you have to interface with your investors. So for example, a private equity fund where you're counting on drawing money down from people on their commitments over time, it's probably not a great tokenized product because you got to find those people and get the money. Similarly, partnerships are a little tricky because people expect their K-1s, their annual tax returns, to come back to them. So this works a little bit better when you're dealing with some sort of blocker and taxes are being handled at the corporate level. So we do have to think about those aspects. You know, to be permissionless and not care who your investors are, you need to actually not need to care who your investors are.
Dennis?
Don't think that's my place to advise them, other than to say, you know, you're good at something as a company, so technology probably is not one of them, those things. So find yourself a reputable technology provider that enables your business use case.
And Rory?
You know, my first advice would be call Stephanie. But beyond that, I think, you know, in my view, you know, the tokenized fund is just a wrapper, right? So ultimately, it comes down to, you know, their ability to, you know, effectively, you know, manage that strategy and produce, you know, returns that are going to be attractive to investors. And then, you know, based on our considerations when we think about tokenized funds, is, you know, who are the counterparties, who are the vendors you're working with, and, you know, how reputable are they? So.
Absolutely. Yeah, you want to align yourself with those that are licensed, regulated, compliant, certified, right? And that's important because there's bad actors in the space as well, so we got to be prepared for that. Got about 2 minutes, so we have time for Q&A. Is that all right? Or are we behind schedule? Okay, very, very quickly. 2 minutes. Any questions?
About ability to, you know, settle or sell in the secondary market your private equity or private market token kind of thing, right? But unless you have a vibrant market-making community, really marketing and making markets in your coin, how good is that secondary settlement where I can exit out of my position anytime soon once I invest in?
Very fair question. One of the reasons why it'd be so great to have those securities exchanges able to handle these assets. And even then, as I say, it needs to be something you're allowed to transfer. I mean, we have explored setting up alternative trading systems, like little private clubs where people can trade with one another for assets that aren't otherwise freely tradable, and everyone in them is a QP or a QUIB, whatever it is you needed, and they trade. But as you say, that's not necessarily such a robust market. So you may think you have liquidity, but maybe there's not enough participants.
We at time? All right, we're at time. All right, well, thank you very much.
Thank you.